In this video, we're going to explain a key phrase that appears in many business loan agreements. The phrase is, the interest rate that will be charged on such loans is tied to. We'll break down exactly what that means, show a clear visual diagram, and work through a short calculation example so you can see how this works in real life. Let's visualize what's happening. We have a bank on the left and a company on the right. The bank agrees to lend money whenever the company needs it, but the interest rate is not fixed. Instead, the rate is tied to a benchmark, like the prime rate or SOFR. That means the loan rate moves up or down when the benchmark moves up or down. Now, let's connect the phrase tied to with a formula. A very common structure is loan rate equals benchmark rate plus a spread. The spread is a fixed extra percent the bank adds on top of the benchmark. The benchmark moves, the spread stays the same. Here is a simple visual of the benchmark rate. Imagine the benchmark as a slider. If the benchmark rises, the loan rate rises. If the benchmark falls, the loan rate falls. This is why it is called a variable rate. Let's do a calculation example. Suppose the agreement says the loan rate is prime rate plus 2%. If the current prime rate is 5%, then the loan rate is 7%. If the company borrows $100,000 for 1 year, the interest cost is principal times rate times time. Now we plug in the numbers. The principal is $100,000. The rate is 0.07, and the time is 1 year. The interest equals 100,000 times 0.07 times 1, which equals $7,000. What happens if the benchmark changes? Let's say the prime rate rises to 6%. The spread is still 2%, so the loan rate becomes 8%. That means the interest cost goes up. This is the key idea behind the phrase. The interest rate is tied to a benchmark. Let's recap. In many long-term bank agreements, the company can borrow more money when needed, but the interest rate is not fixed. It is tied to a benchmark like prime rate or SOFR, plus a fixed spread. When the benchmark moves, the loan rate moves. That changes the interest cost. Understanding this helps you predict borrowing costs and manage financial risk.